Hey, good morning, everyone. Marty Missouri here, September 26, 2020. This video will serve as this week's macro update. Going to discuss the macro, obviously. What changed this week in terms of our inputs and scores. Going to show you a number of charts that didn't change score, but things that are worth looking at. We're going to run through some currencies. Going to spend a little time on the market, some technical stuff, some relative performance, some ratio analyses. And then I want to finish up, time permitting, with just a live chart, and we'll do some live technical analysis together. Again, I'll try to keep it relatively brief. These can take a while. And hopefully worth your time and keep you engaged the whole time. For those of you who like the videos, my apologies. I've neglected you of late. Haven't meant to, but find myself sitting here today feeling more like talking than writing. So in front of you is the PWA index chart from inception back to 2017. We'll look at a back test here shortly. So yeah, we came back, we bounced. People would say, look at this V-shaped recovery. It's really not. It's just, rate of change. Things bouncing pretty nicely. The way we simplify kind of the signal here, and again, it'll make more sense for those of you who are new to this in our back testing. But here's the zero line. When we rolled over the zero line late last July and August is when we began hedging portfolios with an option strategy. And then right at the end of last year, we adjusted how we hedge, got more conservative, added gold and some other things to the portfolios and so on. Of course, you know what happened after that. And then come out of this pretty nicely. Markets have come back, and as you know, and then but here we are showing some weakness, and we'll discuss where that's coming from. So the Bloomberg Commodities Index, pretty big broad basket of commodities. This changed score one notch lower for us, which had an impact on our index. And as you can see, commodity prices rebounded with other markets coming out of this, and then rolling over, lower high, lower low. Not a good technical picture for commodities. The dollar has gotten stronger here. We're going to spend a little bit of time on the dollar as well. Industrial materials, of course, very important signal as it relates to the economy. Came bouncing back, rolling over a bit here as well. So, not a good indication that we're, robustly roaring our way out of this recession. We talked a lot herein. We will a lot more about the nature of this increase, the nature of stimulus, a little bit more on that today as well, and what it all means and how it impacts, just functions, market functions, economic functions, and so on. So weekly jobless claims. Now, it was interesting because the headline, I believe it was from the Wall Street Journal, actually billed this 870,000 this week as something to almost celebrate. We're leveling out. We're seeing some strength. Well, I don't know about you, but it was up from the week before, and that is anything but an encouraging number. Continuing claims at 12.6 million. Factor in programs that don't show up here related to COVID, and from what I understand, it's more like 20 million people remain unemployed, and that the jobless claims actually would be considerably higher. So zeroing in on that and just looking at it, on a very shorter term chart, see, here's that flattening out of jobless claims over the last several weeks, since June, and then here's continuing claims kind of slowing their descent. But history, a la Mark Twain, doesn't repeat, but it often rhymes. And here's a period. This is the 80s recession, 1980. You can see jobless claims, weekly jobless claims peaked, started getting better. Continuing claims peak started getting better, but every now and again we have what you might call a double dip recession. So we came out of that recession, things began getting better. It looks like the line we have right now. I don't know that this is how this one's going to play out, but my thesis suggests that there's a chance here. And then you can see we came out and it got even worse during the next recession. This is back in the high inflation days. The Fed was doing things differently than it does now. The Fed was actually, I would say, actively trying to create a recession with the idea of whipping inflation. These were the days of Paul Volcker. We actually had a Fed chairman who actually believed that to really get through and get out of froth and the things that really hold an economy down, sometimes there's a bit of purging that needs to go on. So he literally raised interest rates through the roof, and it ultimately worked. And the run from here was very, very good. And of course, whole different narrative and conversation to have today. But so here was a situation again where it was looking good, and we really weren't in really good shape. So, but you could have taken this and run with it and made huge mistakes, because we went right back in to a recession just a few months later. So durable goods orders came out yesterday, and as you can see, huge improvement. Again, we've looked at this before, but this was not encouraging to see durable goods take a dip down in this environment right here. Kind of plays into that narrative that the rebounding or the reopening bounce is beginning to fade. Certainly shows up there in durable goods. The truck tonnage is another one that got my attention. This is already scored as low as it can go. So this didn't change the score, but this is kind of falling off a cliff. However, the Cass Freight Index, which I have a great deal of respect for as an indicator, it continues to bounce back. Well, this covers rail and intermodal and all other forms of transportation. So the truck tonnage is one thing. Rail traffic actually looks pretty good. So this continues to be a positive look. Of course, we know there is a lot of activity as a result of the stimulus, and you can see in the past, a bounce during a recession is not out of the ordinary, and then we roll over again. So, folks, this is kind of the look I'm looking for, but we're going to take the data for what it is and score it with the signal that it gives us. Chicago Fed National Activity Index, it's kind of a macro index in and of itself. Big, ginormous bounce coming way off of that. Still at this level, it's historically a good level. I still have it with the highest score. The rate of change continues, of course, is going to have a negative impact on our score. Another week of this or month of this, when this comes out, this will be in the red. But right now, I just wanted to kind of illustrate for you. This is the effect of that big stimulus. I wrote an article recently, and I put "cash for clunker-esque" in the title. Well, this is what that looks like. This was during the Obama era, the Cash for Clunkers program, where, don't remember the actual specifics, but obviously you would get a big chunk of money for a big pile of metal, and it would give you the ability or the resources with which to buy a new car. I was quite the skeptic back in here of that, and I know I wasn't alone. It basically said this is what was going to happen, and that's exactly what happened. We had very big artificial numbers. We just pulled forward, right? Car sales that would have happened otherwise. It took us 3 years later, 2012 roughly, to get back to this one big bounce here. So again, that's kind of the feel, and I think it's reflected in that index that I just showed you, and of course it's reflected in a lot of data that we're tracking. You throw a bunch of money at an economy and you're going to get a bunch of activity. The question is any of that organic? Is this something that's sustainable in any way, shape, or form? Okay, so our private wealth advisors macro index back tested. This is quite the exercise. When more time, probably in the future, we'll go back decades and decades, but this is just back a couple. But these are key points. These are experiences that I lived intensely, viscerally, professionally, in every way, shape, or form. I began back in 1984, so everything since then I got to experience, got to pay attention to, got to notate along the way, study, and then of course go back and study all of economic and market history. But our index, which right now is 50 data points, we score it every Friday. I date it for Monday, but all of the data is in by Friday. And this is what you clients, you'll recall, as I began showing you this in review meetings before we rolled over, that this is going to happen. At some point, we are going to get to a point where the economy rolls over back in here, right? And our index goes in the red. At that point, we'll factor in other things as well. Highly likely that we'll begin getting defensive within portfolios, and highly likely that I'm going to look like a buffoon as the market takes off from there. Why would the market take off from there when our index says things are about to roll over potentially, or the risk is there? is because we're not the only ones looking at these data, and the Fed is, and their economists and other people are. So you can expect interest rates to fall to the floor and the printing press to get crazy at that point. Markets love that, right? But if it's not reality, if it's not organic growth, if it doesn't make sense, stocks just get further um, um, separated from reality, and then reality sets in, and this is what you get. So that is precisely how it played out here in 2008, right? We had that dip, so we had a few months of growth, rolled over, and folks, here we are. Here's back in the summer of 2019 when we started hedging portfolios, started getting defensive, and then kaboom, big rally. You know, I'm an idiot. Big decline, I'm a genius, but nothing happening here, right? Like it was here and it was down in here that would inspire us to get growthy again. As the market bounced back for a while, ironically, the numbers got worse, right? And then they started getting better. And as you can see, we got to a -10 at one point, maybe even just a little below that. And now we're right back here to a -18, which is going in the wrong direction. And that's what I feared when I wrote last week's article is, are we beginning to fade, or is this bounce beginning to fade, economically speaking? The answer is yes, but you know, there's a lot of dynamic data in there, and things can change, things can get better. Who knows what the next few months has in store? I don't know if you know this or not, but there's a big election coming, so that could have an impact as well, certainly on sentiment. Here is an exercise I go through every week just to take the basic top 11 sectors. I separate here the defensive from the more growthy or cyclical sectors. You know, on a year-to-date basis, quite the separation between the good, technology is up 24%, and the bad, energy, is down 50%. Financials, right, down 24%. Consumer discretionary up 20%. Why would consumer discretionary stocks be doing so well? Well, when you throw dollars into some consumers' pockets, well, they're going to go spend it, and that's going to reflect in the prospects for those companies. More defensive sectors, you know, healthcare, staples, slightly in the green. Utilities, interesting that they're not doing better. REITs down 10%. Of course, REITs, you've got a lot of commercial real estate exposure there. The overall markets, the S&P 500 versus the rest of the world, we got in a negative just a little bit. Late last week, we had a nice bounce that brought it back in the positive on the year. On a weekly basis, last week, it just was really rough, particularly for the Eurozone. In the commodity space, bonds, well, bonds and commodities, TLT is government bonds. So bonds, you know, kind of a safe haven. You push interest rates down to zero, you're going to get a nice move there. God help bond owners when, if and when rates begin to rise. We have 23% of our portfolio down here in this second rectangle: gold, silver, copper or base metals, and then ag. And so this has been, you know, really good for us. This last week, they got really hammered. So our relative performance for the first time in weeks wasn't really good relative to the stock market. And it has a lot to do with the dollar rising, which we'll talk about here in a second as well. But anyway, tough week for commodities. You want to own commodities in a world where dollar debasement is essentially required if we're going to, as I say, get out of this alive. And I've spent time on the blog there, and I'm sure I will more going forward. The price to earnings ratios, valuations are terrible timing tools, but you know, you got to look at them. I mean, you know, guys like Warren Buffett, and you know, one of the best ever, valuation is real important to him. Your big value investors, the good ones, will talk a lot about things like the price to earnings ratio. We're still way above, you know, anything historically except for the 1999, you know, tech bubble experience. Price to earnings, you know, they can be manipulated. Earnings, you know, you can play a lot of games with your accounting to make earnings better. Where they've really been manipulated, which makes this pretty scary when you think about it, is all the share buybacks, something like 6 trillion through here. The biggest, or the only net buyer before we were done of stocks during this big bull market was companies buying back their own shares. So when you buy back your shares, you take them out of circulation. Therefore, your earnings per share, if your earnings stay the same, look fantastic. Well, this is the price per share to earnings per share. And so what if all those stocks didn't get bought back? What would the price to earnings ratio be, dear? That's a scary notion. It would be far and away at all-time highs. So unequivocally, certainly by this metric, stocks are expensive. Now, revenue, sales, harder to manipulate. I mean, we still have the whole reduction of shares through share buybacks to talk about in terms of what this would be without that. But look at the price to sales ratio, right? Harder to manipulate. It eclipses the all-time high, I think, in the late 90s. So make no mistake, folks. People may argue that stocks are cheap by some metric. They might compare the earnings yield to the yield on the 10-year. Yeah, you're right. It's cheap by that metric. Total market cap to GDP, I don't have that chart here, but that's Buffett's favorite indicator. Off the charts, all-time high. So stocks are expensive. Doesn't mean they have to go down. Just means, you're buying something that is expensive. There's just no ifs, ands, or buts about it if you're buying stocks right now. Okay, so some of the technical stuff that we look at, what I'm doing here is I just cut and pasted some of the charts of my long, lengthy weekend analysis that covers a lot of things, and I just pulled from what I think is interesting. So the 50-day moving average, this is the S&P 500, this is the green 50-day moving average, 200-day moving average. Why are these important? Well, because people think they are, right? You can see back here when the market rolled over, we pierced that first, found some support here at the 200-day for a little while, came down through that. This rolled over. They called that a death cross. Probably people put so much emphasis on that. Probably one of the worst technical indicators. Do not rely on that. But anyway, so as you can see, the death cross was happening and the market was going up. And then we had the golden cross, so what? Just kept going up. So now we pierced the 50-day. A technician would tell you probably go back and test that over the next few days and then come down. And what should happen? Well, we should find support right there at the 200-day moving average. And then we'll see, where we go from there. This is just a longer term chart. You can see the market rolling over it, the tech bubble and then the real estate bubble. Okay, so the 200-day moving average, and these are the number of companies in the S&P 500 that are trading above their 200-day moving average. So the index is substantially above, but only just barely over half the stocks are above the 200-day moving average. What does that say? That breadth of the market, the all boats rising with the tide notion just isn't there. So weekly moving average convergence divergence, RSI, I won't get into definitions. I'll just tell you those are momentum indicators that have worked for us from a technical perspective over the years. Now I've been drawing upward sloping wedge patterns forever and showing the negativity of that. Well, we really have now what's called a megaphone pattern. And that, for the most part, is a bearish pattern as well. It just shows you the big divergences here. Huge, big battle between the bulls and the bears. This is actually bullish. This is a weekly chart again. So this is bullish. The weekly MACD went through what was a bearish divergence. So if we can just kind of stay up there and move with the market, that's a good sign. The relative strength index, however, still is very much in a bearish divergence, which is a negative sign as to the sustainability of the current rally. The monthly, same indicators, MACD and RSI, got the megaphone. This is bearish. This is bearish. So the longer term technicals don't look so good, at least the ones that we put together for our weekly analysis. Here's something that's a little more positive, not the ratio to small cap. So this is the S&P 500 ratio to small cap stocks, right? So small caps more economically sensitive. Small caps start outperforming. That says good things about prospects. Underperforming, it doesn't. You see how it was rolling over before this big bear market, before this one, before corrections and so on. And it's rolling over again here. Transportation stocks, of course, very sensitive. Truck tonnage didn't look good, but the Cass Freight Index looked good and rail looks good. You can see it was rolling over here. It's actually confirming the rally. So in terms of transportation stocks, that says something positive about where we are currently. So it's not all negative. This one is negative though. So this is the S&P. Here's your megaphone. This is the S&P to TLT, which is your longer term Treasury bond index ETF. So the ratio means that when this goes up, stocks are outperforming bonds. When it goes down, bonds are outperforming stocks. So we had some touch and go periods here. And by the way, folks, we stayed growthy all the way up the whole time until right in here. We had these issues in here. Our macro analysis, which wasn't formalized in an index, but we've been doing it for the last 30 years, said that everything was okay from a general conditions perspective, even though the markets were breaking down. That was about a 16% peak to trough move. Also, what was giving us confirmation was that while we had lower highs, we had higher lows. So we weren't breaking down. But look what happened when we broke down and then we just kept going down. That is a technical indication that this is meaningful. And what do we have now? The same kind of thing, and we're rolling over as we speak. So this is a negative score in our index, as you might imagine. Okay, so getting a little more into the weeds, every Friday afternoon we see the commitment of traders report, and there's a dozen or more different markets that we track. And I want to show you just the S&P 500 and then the NASDAQ. So this is net exposure, whether it's long or short. If it's above zero, they're net long, meaning they're betting that the market's going to go up on balance. The more of them are long than short. When it's below that, they're net short, meaning they're betting that the market's going to fall. So suddenly, we've had 3 weeks of bullish indicators here for future speculators who trade S&P 500 futures, right? So those of you who've been with us and with me on the videos and the blog know that in here, this was just epically big pessimism. And the point I was making, though, is this is actually kind of bullish, because when you're short something, you've sold it and you got to buy it back. And you're betting you're going to get to buy it back at a lower rate or a lower price and collect the difference. Well, if the thing moves against you, you can lose all you have. So my point was always look for these big short covering rallies. It's really going to be tough for the market to roll over hard or stay down or not have big rallies, maybe I should say it that way, with all of this short interest. Well, that's gone. In fact, it's quite the opposite. So this is not there to support. This suggests that there can be, some pretty aggressive selling as these people get shaken out if we get a downdraft in the market. This is the opposite extreme. So back here, as I showed you, traders have been pretty bearish on the S&P, therefore potentially a bullish impact when they change. They've been bullish virtually the whole time. We had a little click there and a dip there in May. Speculators who trade the NASDAQ, right, where most of the tech stocks are. Well, last week I pointed this out to my team and said, "Woo, that was 12-year low on short interest." And I said, look for short covering rallies, right? And so what happened yesterday? Big rally, but the rally was twice as big in the NASDAQ, and this is the NASDAQ 100 index, than it was anywhere else. Surely, I was thinking there's some short covering. So I was very interested to get to yesterday afternoon to see if some of this came off or if it would. Now, remember, this is, I don't know if I told you this, this was as of Tuesday. That's the best they give us. So last Tuesday, while the market was rolling over, we had short interest we haven't seen all the way back to 2006. So we had that big strong rally that was twice as good as anything else yesterday. I think very likely that there was some short covering that had to be done here. It'll be interesting to see what next week looks like. QQQ, the ETF that tracks that index that I just showed you. Short interest in QQQ has been going up substantially. So traders are getting very negative on the prospects for technology. But what does that mean? That means there's a lot of short interest that if tech starts to rally, they may have to cover it, and that's going to exacerbate the rally, not because they're bullish, but because they're just trying to protect themselves. So there's some fuel for tech to bounce back like it did the yesterday, or I think Thursday as well. But on the S&P 500, short interest continues to fall hard, right? So notice where short interest was before the market rolled over, right? And so in here, that there's just, everybody's bullish. Things starts to roll over. They start shorting the stocks, which means sell them, and look what happens. It just exacerbates, or it can exacerbate what goes on. But when we have high short interest, back when we were still bullish in December of 2018, when the market had taken almost a 20% dip, I was doing videos saying, folks, just a little bit of good news. These folks are going to have to cover, and that's just going to shoot this thing through the roof. Well, we got back there at the bottom here, and it doesn't mean that the market has to, because people can remain short as long as bad things keep happening here. Well, we don't have that support for the market. In fact, we're getting close to this, so we have quite the dichotomy, right? You got a NASDAQ that looks like everybody's bearish on it, and therefore, if we have a bullish move, they need to cover, and they just exacerbate the upside. Then you have the S&P 500, which has the biggest allocation to tech that it's had forever, but it's not like the NASDAQ. And there's just people are still very sanguine in terms of who would short this thing. So interesting stuff to watch. It does explain to no small degree sometimes the big moves in the market on a daily basis. Okay, so currencies, the US dollar. I was illustrating this back in here on the blog, talking about the fact that, well, the powers that be want this to stay low. Looks like there's other factors that are maybe getting in their way. So this pretty much certainly explains what happened to commodities this last week. You want to continue to own commodities here, and we're going to get that kind of volatility. But certainly this explains it more than anything else. It also explained up until yesterday the stock market. So I've made this case that stocks and the dollar are very negatively correlated. But I've also said that we could see a moment where a stimulus package has stocks and the dollar going up at the same time. Well, yesterday stocks pretty much defied the rally in the dollar. I thought one of those should have rolled over or rolled higher or what have you. Well, stocks didn't roll over and the dollar stayed elevated. Apparently, a lot of that euphoria or that optimism yesterday had to do with the fact that Pelosi and Mnuchin were talking yesterday about potential stimulus, right? When you look at the dollar, you want to look at the euro. If you're looking at the dollar index, which is what I just showed you, because the euro is the biggest factor in there. And so here is the opposite. Here's the euro getting overbought. Here it is breaking down. Here's moving averages looking ominous. And then here's the momentum breaking down. Euro goes down, dollar goes up. High euro is problematic for Europe. They're a big exporting economy. And the euro relative to emerging market currencies, this is relative to the dollar, has been very problematic for them, and because they export to emerging markets a ton. So my point had been, the European Central Bank really has reason to see if they can manipulate this lower, and if they do, that is essentially going to make the dollar go up. And so maybe seeing some of that right now. This is actually a pretty big move. We'll see how long that goes. So the Japanese yen looks like it's rolling over as well. The Great Britain pound, a lot going on there. It's rolling over as well. The Aussie dollar rolling over as well. Those are some major currencies. We track over 24, something like 26, 27 currencies we pay very close attention to. I just feature on our weekly analysis these. But so you've got those technically not looking so good, and then there's the good old dollar. That is an issue for asset prices for sure. Okay, so I think that's the end of, it is. That's the end of my slideshow today. Now I want to spend a couple more minutes. If you're still with me, thank you. I can go in all kinds of directions. I can paint fancy pictures and lines and so forth, but I thought I'd do more, but looking at the clock here, we'll just talk about retracement. So Fibonacci retracements, technicals are important. Early in my career, I called them, mumbo jumbo. Then I really began to study them. It's funny how if you don't understand something, then you want to criticize it. Well, once I got to understand it, if only because lots and lots and lots of people trade the technicals, and some big hedge funds do as well, we better understand them, right? So these retracement levels, right? There just seems to be kind of a standard sequence. It's interesting because Fibonacci retracements and the Fibonacci math kind of works in many cases throughout nature, but they seem to have relevance in the stock market as well. So here's the big drop in February to March. And then here we were chasing. So you notice we've colored the lines here, or Bloomberg has green, blue, and green. These are the key levels. These are the ones where you see more activity. So here's a big bounce right up to that 38.2, and look what happened. Big gap lower, right? Bottomed right here at the 23.6% retracement, came up, hesitated right there, blew through it, battled with the 50. This one's probably the most important. And then for, a good month or so, played with that 50, just bounced close. Swing traders had a good time if they were on the right side of this. You went short, you went long, you went short, you went long. Came through there, and this right in here is where I was looking for this thing to roll over. But it's hard to battle against unlimited printing, right? And that's essentially what you got. So we got these big gaps up, blew through here, even fought with that line for a while, and then boom, we're at all-time highs. Okay, so now I want to just kind of play with this a little more and just kind of show you how important these things can be. So here we were at all-time highs on September 2nd, and then I want to play with my retracements here. So first we came down. This is what I was showing to our group in terms of our our investment committee and our research team internally. I said, isn't this interesting, guys? So we came down, we bottomed. Here's that 38.2 retracement. 2 days. It sure battled with it, but it failed. And so we came down. Then we bounced off of the ultimate low right here, and then we come all the way down through that. And now that's where the market stopped on Friday. So if indeed we do break through there and you trade on Fibonacci's, well, then what we look for is this level right here. And ironically, it's right at 33.50, and it also have the 50-day moving average right there as well. So if we shoot through here this next week, wouldn't surprise me in the least. This market's going to be up against some pretty stiff resistance right here with the Fibonacci level, with this number right here. And if we draw a line through it, I can almost assure you that there is some other activity. If you went further back, it would be there as well. So we'll see how that plays out. If that fails, right, and we find ourselves traversing lower, we've got 3,200 right here. That's going to be an important area. And then, folks, I mean, certainly the conditions, and a lot of what I'm seeing in the technicals and market structures and things, and the options hedging that we talked about, if that begins to flip, there is more than enough juice to have this thing fall precipitously down. And with the prospects for stimulus and election results that the market likes, there's also the prospects for this to happen. That would not surprise me in the least either. The question is, which one of those better reflects? Will we be getting closer to economic reality down here and begin to look at something actionable? Or will we be closer to economic reality up here at all-time highs and look at something actionable? So could we end up really re-engaging and getting into tech and getting more growthy and getting rid of our hedges and abandoning our commodity defensive plays at higher levels? Of course we could, but we've got to have general conditions. The macro conditions has to be the basis of that, folks. So again, during times like these, a firm like ours, could be very, very frustrating for someone who just thinks about market prices and momentum and that sort of thing. We have to take it all in. And as I've shown you, a little bit of back testing here, a little bit of history, but all of my experience and all of my studies say, or have me saying this: I don't know if it's going to be that sometime soon or that. What I know is the risk right now is super duper high, right? And I'll leave you with this analogy. Clients who we talk to frequently, you've heard this from me. But so we're at the edge of a lake, and the lake is frozen over, and I am your guide. And when we approach the lake, people are having a ball. They are skating on that ice. They're jumping up and down, sliding. The kids are going crazy, all on that ice, and it's not breaking, right? And here we are over here, and I'm sticking life vests on you and inner tubes. I got a pulley on your back, and I've got a rope going around a tree behind you. And you're saying, Marty, what are you doing? I mean, even if I get out on the ice, I'm not going to have any fun because you've got me all strapped in. And look at, why are we doing this? I mean, look at this. These guys are having all-time high fun, and you've got us messing around on the shore. And I'm going to say, well, what you didn't notice is before we got here, or right when we got here, I was up ahead of you, and I was measuring the thickness of the ice, and I was taking the temperature and looking at my notes from the past. Sure enough, in the past, when the ice was this thin and the weather was this warm, the ice broke and people fell hard. And a lot of people still haven't recovered from that. So I don't know that the ice is going to break. We may get a big storm, and that ice may get really, really thick. And I may measure it, and I may take the temperature and say, heck, this is great. Let's go have some fun on the ice. And yeah, we wouldn't have had as much fun as the people who were dancing on it when it was thin. but we never really had our lives in danger, right? Anybody who's playing in this market unhedged and undiversified is playing with fire. And we know from the statistics, there is a whole new group of investors, reminds me of the dot-com clan back in the late 90s, who have no experience, and they think this is easy, and they think the ice is thick. And as long as the Fed is there to keep, trying to refrigerate it and keep it thick, they're going to be okay. Well, they absolutely 100% could be right. But if they think that the risk isn't there, 100% unequivocally, they are wrong. And so, folks, this is, your clients, we hope you appreciate this. We're just not leaving it open to choice, frankly. We're just not willing to play unprotected, unhedged. Sure, right, we're going to go down. We're going to go down a few feet for sure if the ice breaks, even with our inner tubes and stuff on. But there's some buoyancy in what we're doing, right? At least when we test it, right? And that was certainly a lot of buoyancy when the market fell apart in March. So we want to keep that buoyancy as long as conditions are what I just described. I have kept you forever this morning. Thank you, as always, for watching and listening. And hope this was helpful. And I'll be back soon. Bye-bye.